Hello learners, welcome again to our session today. It is a continuation of what we started earlier on, and today's class I want us to look at a second question of sensitivity analysis. So the concept that I want us to handle today, it is more the same of what we did earlier on. Recall the concept of a break-even analysis. So this time round, suppose you're dealing with a concept of sensitivity analysis and you have concepts to do with scrap value. How will you treat this in our computation of our NPV? Ideally, you'll find that it is almost the same concept that we did at our basic level of financial management. So in this case, we'll be working out the concept to do with sensitivity analysis. Recall the basics of sensitivity analysis, whereby first of all it will be upon us to understand that I'll be looking at variables, financial variables that will have an impact in our original NPV, so that as at the end of the day what you want to do is to avoid not to generate a negative NPV. So the whole idea, you'll find that we are going to be capped at a point where our NPV is equal to 0, and that is the concept of break-even point that we had looked at in our last class. So in our session, my good students, let us have a look at that question of ours, still sensitivity analysis. And again, you'll find that it is more the same as what we did in our last class. So the only item that you're going to introduce here is a concept to do with what? Aspect to do with scrap value. Now, maybe just to remind you in relation to that, at any given point when we are required to determine our net present value, the same procedure normally tends to apply, where we normally tend to talk of our present value, of course, of our cash inflows, present value of cash inflows, of course, minus what? Our initial outlay, minus initial outlay. This is the whole idea of our NPV, right? Where in this case we say that depending with what we are looking at, depending with how we are given our cash flows, they might be either aspect of lump sum or they might be aspect of annuity. In this case, recall we say that we should always be very keen with that. But the whole idea will be the cash inflows. The whole idea will be the cash inflows. Recall the cash inflows, where we said basically for us to determine this, I'll be taking, of course, our annual revenue, or basically talk about our sales minus our variable costs, minus variable cost, of course, or you can term it as operation cost, minus our fixed costs here. Okay. In this case, of course, we can talk of our depreciation, minus depreciation. All this, we are going to deduct our tax, right? Then after we have worked out all these components, you're going to add what? We are going to add our depreciation back. We're going to add our depreciation back. We're going to add our depreciation back. This should give us our net annual after tax cash flows, right? Still, better still, you can still recall, on the same note, we say that you can either use a concept of contribution. So you can talk of either contribution minus any operation cost that you'll be having, which in this case we're referring to them as fixed cost, minus aspect of tax, right? So that as at the end of the day, we are going to add what? You're going to add depreciation tax shield. Depreciation tax shield. Recall what we did. Now, at this point, in the event that maybe you're going to sell your asset as at the end of its useful life, there's one important thing that will come in place here, which as at the end of the day, after we have determined the present value of these cash inflows, it will also be very important for us to consider our terminal, but our aspect of what? Scrap value. So in this case, that is to say, whenever we are having our scrap value, when you're having our scrap value, as at the end of the period, you'll find that for us to basically determine our NPV, I'm going to take our present value of cash inflows. We add present value of our aspect of what you're talking of scrap value, present value of the scrap value, present value of the scrap value, present value of the scrap value. In this case, we are going to have all these items. Now we deduct what? Our initial outlay. We can all agree that nothing much has changed other than us introducing our scrap value. Nothing much has changed. So let us look at this question of ours and see what we are supposed to do. So I'm sharing this question with us here. You can take a screenshot of the question, or better still, you can download the question just below what you're doing. So in that question of ours, these are what basically we were asked. We are told that a company is considering whether it is necessary to purchase an equipment to increase its production and sales volume. The equipment costs $500,000 and a useful life of 3 years, after which it can be sold at scrap value for $80,000. The annual sales revenue and operating costs are $600,000 and $390,000 respectively. The company cost of capital is 10%. So here we are required, number one, to compute our calculate the project net present value. Part two, compute the percentage changes required in the cost of equipment, the scrap value, and the sales revenue for the project to be rejected. So a maximum that we can't go at all, if it is either aspect of increase in profit or if it is aspect of reduction of revenue. The maximum that we can't go, because if you go beyond that point, of course, the project will not be viable. So in this case of ours, let us start by, of course, computing. I can squeeze this question down here. Allow Mwalimu to squeeze this question down here. I believe the question is still visible, so let us work it out. The first thing that we need to determine here is to compute our present, or rather our aspect of our NPV. So we realize that I'm having our scrap value, and the good examiner is telling us here that we had an annuity in terms of what we are receiving in terms of what? Revenue. Because you are told that here the annual sales revenue, right? And operating cost. So basically it is annual. I'll be receiving that annually, and the equipment costs $500,000. It has a useful life of how many years? 3 years. So given such a question, my good students, where are we going to start from? So I know very well that my net present value therefore should be present value of cash inflows plus present value of our scrap value right? In this case, of course, we are talking of minus initial outlay. This is the first thing that we should establish. Right? The next question I'm going to ask myself is that our cash flows, what will we be having as our cash flows here? Our cash flows, we are given annual cash flows, meaning that we were having the same values all through, giving us annuity. So, in other words, if we were to break this, basically, we can have our NPV to be equal to our cash flows, which in this case, you are talking of our cash flows, annual cash flows, Okay, we multiply by present value interest factor annuity, given our rate number of years. We add this number of years, or n. We add our scrap value. We multiply by present value interest factor. Why are we taking lump sum? Because in this case, I'll be receiving it once, which is as of the end of the period, which is the scrap value. So it is not annuity, so it is lump sum. So given our rate, so all this, we are going to less initial outlay. We're going to less our initial outlay. So that is the first thing that you should establish for you to work it out correctly. Now, the other item here will be, let us determine our present value interest factor annuity. Given what rate? Look at our question. We are given a rate of 10%, 3 years. What should we be having? 1 minus into 1 plus 0.1 raised to negative 3. We are going to divide all this by 0.1, right? Because it is R. Whereas for scrap value, present value interest factor annuity, not annuity, but present value interest factor, 10%, 3 years, where I should be talking of basically 1 plus 0.1 raised to negative 3. Let us determine those factors first of all, or you can still use your table. You can still use your table. The annuity table and lump sum table. So the first case, I'm having 1.1 raised to negative 3. 1 minus answer divide by 0.1. So Mwalimu is getting Mwalimu here is getting 2.4869. Kindly you can confirm with your figures. 2.4869. The other one I'm getting 1.1 raised to negative 3. 0.7513. So I've determined our factors here. So after we have determined our factors, the other thing will be simple, because what will we be expected to do here, my good students? I'll come and determine our annual cash flows, which our annual cash flows you are given, you are generating a revenue of how much? You are generating a revenue of 600,000. That is what you are given. Basically, we are told that we had 600,000 which were generating as revenue, minus our operating cost. In this case, the operating cost you are given what? Operating cost you are given 390,000. Operating cost you are given 390,000. 390,000. So having our 390,000, that is our cash flow, annual cash flow, times present value interest factor annuity, given the rate and number of years which we have determined it to be 2.4869. After we've worked it out, you are going to add scrap value, which was 80,000, present value interest factor, rate a number of years, 0.7513. So all this, we are going to less our initial outlay, which our initial outlay was how much? 500,000. So what will we be having here as our NPV? I should be talking of 600 minus 390 times 2.4869 plus 80,000 times 0.7513. This should give us 582,353. We less our initial outlay, which was 500,000. So that as at the end of the day, my good students, what will be our NPV? We can agree and say that therefore our NPV in this case will be a figure of how much? 82,353. This will be our NPV, clearly showing that this project is viable. The project is viable. The reason we have a positive NPV. The reason we have a positive NPV. Very important for us to have that in mind and considering that. Believing that we are all on the same page, my good students. Believing that we are all on the same page. Okay, after that, we go to the next question. What were we told? Compute the percentage change if the cost of equipment, scrap value, and the sales revenue for the project is to be rejected. So what examiner is trying to tell us that we need to basically determine the percentage change of our variables to a point where our NPV will be equal to 0. So that is break-even point, because below that point where our NPV is equal to 0, it means that the project will be rejected. So we need to determine a point where I'll be having our NPV to be equal to 0, given our variables there, which in this case, we are told to work out the initial cost of the equipment, scrap value, and the sales revenue for the project to be rejected. So those are our variables: cost of equipment, scrap value, and the sales revenue. So what are we going to do? We need to conduct sensitivity analysis. So allow me to erase here. We need to conduct sensitivity analysis. So these are what we'll be having here: sensitivity analysis. On the following variables. The first variable that the examiner had given us was what? The initial cost. So we need to conduct sensitivity analysis of the first variable, which is what? The cost of equipment. So sensitivity analysis on the first variable, which in this case a good examiner has given us what? Cost of equipment. That is what you are given. So we need to determine the cost of equipment that I'll be having for us to have our NPV to be equal to 0. So here my NPV is equal to 0. Our cost of equipment, which is initial outlay, I don't have. That is what we need to determine. Take it as X, because that is what will be required to determine. Take it as X. So once we have this, we've set a stage for us to determine now everything, right? So what will we be having? We take our initial formula of NPV, where we had our annual cash flow. We had our revenue. Remember, at this point, first of all, my good student, if you're doing it in isolation, all other factors are constant. All other factors or variables are constant. All other factors or variables here are constant. So what should we be having? I should be having basically our revenue, which is basically 600,000, minus our operation cost, which is 390,000, times our present value interest factor annuity, which we are determining it to be what? Present value interest factor annuity, my good students, you had computed it to be that was 2.4869, right? Present value 2.4689. I believe that is what you had computed. 2.4869. Recall we had computed that 2.4689, 2.4869. So all this, we add our scrap value, which was 80,000, times our present value interest factor, which we are determining it to be 0.7513. 0.7513. Now, what we don't have, my good student, is our initial outlay, which is the cost of the equipment, which we've equated it to be X. At this point, my NPV is equal to 0. At this point, our NPV is equal to 0. At this point, our NPV is equal to 0. So what will we be having? We can agree here that what we should be having here, therefore, we should be talking of what? Work it out and give me the value of X. So the value of X, literally, I'll be having 600 minus 390, right? Times, of course, just a moment. Times 390, or rather 600 minus 390, times 2.4869, right? Plus 80 times 0.7513 minus X. So I'm having here, of course, this is I'm having 582,353 minus X, which is equal to 0. So you can agree and say here that our initial cost that will equate our NPV to be 0 is the same as saying I'm having X to be equal to that we've taken that to the other side, 0 to this other side. That is the same as 582,353. So this will be our new cost of equipment. Recall, the examiner here wants us to determine the percentage change. The examiner here wants us to determine our percentage change. So how will you determine our percentage change? That will be easy, because for us to determine our percentage tolerable change, I'll take our new variable that we've computed minus our old variable that we had. We divide by our old variable times 100, where in this case I'll be having my new variable that we've computed, we can see, is 582,353. This will be our new cost of capital minus old cost of capital, which was 500,000, which was cost of equipment, not capital. We divide by 500,000 times 100. So therefore, I should be talking of minus 500,000 divided by 500,000 times 100, which should give us here 16. Percentage change should be 16.4706%. So how can we interpret this percentage, my good students? How can we interpret this percentage, if at all that is what we have determined? Yeah, believing that that is what we've determined there. Have it right, 600 have it right, have it right, have it right. Giving you time to internalize as we can see what we had here. So basically that is of course one. So have it right, have it right, have it right, 2.4869. So once we have that in mind, of course, the next thing that we are going to do is to interpret this. So in form of our interpretation, how should we interpret it? We can clearly say here that for this project to be rejected, that is to say that the cost of equipment should increase by more than 16.4706%. For this project to be rejected, the cost of equipment should increase by more than 16.4706%. Because if that cost of equipment increases by more than 16.4706%, it will clearly show that my NPV will be negative. It will clearly show that our NPV will be negative. And that is not what we need. That is not what we need. That is not what we need. That is not what we, that is ideally is not what we need. Now, quickly, my good students, I want you to do this favor for Mwalimu. I want you guys to basically work out. The other point where we are talking of our second variable using the same concept. Our second variable was what according to our question. Our second variable here, we had scrap value. We had scrap value. We had our scrap value. So our second variable here is scrap value. That is what I want you guys to do for Mwalimu. Scrap value and share what you're going to achieve. So that is to say here, my NPV is 0. Our scrap value here, our scrap value basically is X. All other factors remaining constant. That is to say, what you are going to change here is our scrap value, which we don't have. So basically, I'll be having X. Our initial outlay will be what we had earlier on. Which was 500,000, and my NPV is equal to 0. So in this case, guys, I want you to work out for me X. Give Mwalimu the value for X. Then after you've done that, the same concept come and determine the percentage tolerable change, just the way we've done it here. And in that case, you do that and do for the third variable. I think now things are very, very simple, right? This question, of course, you can get it just below this video. To that point, guys, thank you so much. Next class, you're going to handle the impact analysis. Still recall sensitivity, said you'll be having two approaches. The first approach was break even. The second approach was impact analysis. So that is what you're going to do in our next class. To that point, guys, thank you so much, and let us meet in the next session. Thank you.